Well, hi, everybody. I'm glad to be here with you. As my title slide indicates, I am a professor at the law school. You should also know that I am a licensed North Carolina attorney. So I've tried in that capacity to make most of my talk as practical as I can for all of you out there in the real world practicing law. But every so often, occupational hazard, I'm going to geek out on insurance. And if you're going to invite a professor to talk, that's just the price you pay. I should also say one other thing. Some of you know this about me, that I actually am also an insurer. I am on the board of directors of one of the largest nonprofit insurer of coastal properties in the coast. It used to be called the Beach Plan. Now it's called the North Carolina Insurance Underwriting Association. I'm actually a political appointee. Appointed to it for the last 10 years by the Commissioner of Insurance. And so from time to time, I will also be able to give you the perspective from inside the industry of how a disaster affects the institution of insurance, the business entity of insurance, which of course eventually will work its way down to insureds. So I'll do that. That said, you'll notice here I am showing my lawyer cred at the very bottom. No matter what I say today, it is entirely my own views in my academic capacity. I am not speaking at all for this nonprofit of which I'm a part, the NCIUA, or even how I would act when I'm on the NCIUA. That said, let's just take a moment and talk about the pandemic generally. This is where the pandemic is at the moment, both in terms of cases and deaths. As of about an hour ago, just looking worldwide, there are 115 million cases of the pandemic, and of course, growing, and 2.6 million deaths. Here in the United States, we're at almost 520,000 deaths as of today. And we've had almost 30 million cases of the pandemic. With luck, I'm sure I join other presenters today in hoping that maybe we can see light at the end of the tunnel. I hope all of you get your vaccinations if you haven't already in the reasonably near future, and that people don't go crazy just because the vaccinations are out there. And actually by this summer, hopefully definitely by the fall, we get to start to return to some semblance of normalcy. That said, I can tell you, I am one of those people that has received both of my vaccinations, partly because I was in the vaccine trial over the summer, in the Pfizer trial, when they wanted someone my age to give me the shot to see if I keeled over dead. I was happy to volunteer. And one of the benefits of it is that, and I was given the placebo, by the way, but when they finally unblinded us in early February, when it became possible for my age group to get the shot, I was able to go get it and then get the second one. I haven't changed how I view the world hardly at all. So I'm hoping most people don't really go crazy. That said, when I say an inflection point, I'm also talking about two things. One is the huge amount of losses that have been accumulating so far that are going to have to be handled by insurance is part of the insurance notion. The second thing is how many losses, extreme losses, we can still project, hopefully, at least in the United States, only until the near future. And then the inflection point is, once this pandemic starts to wane, there actually are going to be a whole slew of issues, legal issues that will have insurance tails, insurance implications to them. Like, for example, what happens if an employer requires an employee to get the vaccine as a condition of going to work? What type of litigation might that spawn? And is the employer covered for those sorts of issues that undoubtedly are ahead of us? If you're overall trying to figure out what the hit is, and now I'm moving into one big global view of how the insurance industry views the pandemic, I'll just start by saying what is obvious. You can't put a dollar figure on the amount of suffering that this pandemic has caused, especially among people who've gotten sick, certainly among people who've died or had loved ones die, and just the anxiety that this thing is called. Let's just agree that that's immeasurable. That said, there was an estimate, this is a year ago. The World Economic Forum, when this thing was just unfolding, thought that this was going to be a $1 trillion hit to the global economy. And as you may know, insurance is the world's largest industry in terms of the overall amount of premium dollars that it brings in. If insurance were a country, you'd actually have the United States, China, and the country of insurance as the largest ongoing entities in the world. And because insurance, through all the lines that it's insured, sort of finds itself on the front line of losses, it's a pretty good aggregator of these losses. And to the extent the insurance industry is going to have internal problems, financing problems that may result, for example, in rate increases in the coming years, this is a good question to ask. What do we think the overall amount of losses that the pandemic is going to cost? So in March 2020, this thing was just unfolding. Remember March 2020? That's when they canceled March Madness, and we realized this is a thing if we didn't before. They said $1 trillion. By the end of the summer, Lawrence Summers, who many of you know is a Harvard Law economics professor and former government official, revised that number up to $16 trillion, was the best guess of what the economic losses of the pandemic are. And of course, at this point, that will soon be almost half a year dated. And I wouldn't be surprised to see that number drift upwards. And just because there might be light at the end of the tunnel, by the way, here in the United States, the tunnel is much longer in much of the rest of the world. Remember that big map of the world, where the virus is in some ways just in full-throated acceleration, and the vaccine rollouts are nowhere near as imminent and occurring as they are here in the United States. So these losses are going to keep rippling through the worldwide economy for a while. And I'll show you in a moment why that could matter to our insurance rates here at home, no matter how quickly we get on top of the pandemic. So when you try to think about the hit to insurers themselves, by the way in which you figure out what the worldwide hit to insurers is, this is a combination of me, by the way, in my insurer capacity and my geek academic capacity. This building here is Lloyds of London, which is actually this white building that I'm circling with my cursor in, what I assume many of you know to be the very famous part of the business skyline of London. This is the reinsurance heart of the world, and Lloyds of London is actually the spiritual home of all insurance and the place where reinsurance in particular is found. Reinsurance is insurance for insurance companies, and they will carry a fair amount of this risk to some point, but in case there's a catastrophe, they pay for reinsurers to step in and pick up the amounts. The reason this matters is reinsurers, of course, are going to be aggregating the losses, these trillions of dollars of losses worldwide. And as that happens, the price of reinsurance is going to go up. And as that happens, the price even to domestic insurers in the United States to get that excess coverage is going to go up anyway. So when I ask the question, what's the hit to insurers? It's not all that academic. It's going to directly affect all of us. By the way, you're not allowed into Lloyd's. I thought you might like to see. I go into Lloyd's all the time because I buy reinsurance on behalf of our catastrophe loss insurance company. And they're actually always happy to see me. Here we are actually buying reinsurance from a company called Ascot. And we go in and we buy a tranche of reinsurance, and we spend however many millions of dollars a year to make sure that when North Carolina goes into every storm season, hurricane season, we have enough financing on hand to cover what we calculate to be a 1 in 100 year storm, which is roughly somewhere between $1.5 to $2 or $3 billion is what the cost to our insureds would be. So we make sure we have financing from reinsurers to do it. So if you're trying to guess what the worldwide hit to insurance is, last May, when the pandemic was just unfolding, Lloyds actually issued a statement saying that they expect it to be here, about $300 billion is what they think the insured losses are. Remember, people at that time were estimating the overall losses to be about $1 trillion. And that means that about 1/3 of them might be covered by insurance. The rest would not be. That was one of the earliest claims that were made. The chief executive of Lloyds at the time said, if this is true, it's actually historically one of the biggest losses the insurance industry from a financial side has ever faced. Of course, it deals with what you might think of as regular catastrophes all the time, like hurricanes and things like that. It knows how to project those, and accordingly, that is baked in to the rate structure. And they have enough money on hand to have money in their reserve account or to have purchased reinsurance in the event of heavy high triggers. This wasn't seen by anybody. And so that's why he was a little bit worried about what could have been a $300 billion loss. A study just the next month recalculated the loss to insurers from $300 billion up to $550 billion. And that was only on the medical side. So the unplanned for hit to insurers is not insignificant. And so when you're trying to answer the broad question, what's the effect of COVID-19 on insurance? Think about the industry for a moment. The reason that matters, as I said, is it's going to get refracted through increased premiums in the years to come. And this is the last really geeky thing I'll say before I get down to things that I know matter to you. You may remember last spring that the World Health Organization, for the longest time, just wasn't calling this a pandemic. It's an official term. One of the reasons that was especially interesting in the insurance world is there were a group of hedge funds that had actually exercised a cat bond through the World Bank, in which they agreed to pay out $150 to $200 million, some large amount, it might have even been more, if there was going to be a pandemic. And a pandemic meant declared by the World Health Organization. Between you and me, what are the chances, anyone thought, that a worldwide pandemic is going to happen? Very low. So they were paid a premium for what was thought to be a very low risk. And the trigger for it was that the World Health Organization would say the word pandemic. And when they finally said the word, all those hedge fund investors lost that money. They lost all of it. And it went to the World Health Organization, which had insured against the possibility to be redistributed mostly around the world in countries that would have trouble coping with the disease. By the way, I give a shout out to the hedge funds involved. They said, look, we lost this bet, but we're going to win and lose lots of bets. We're hedge funds. We're going to end up winning. And in this case, although we're sorry we lost, we're glad that there's $200 million or whatever the amount is that's going to the World Bank, because we, like everyone else in the world, will soon reap the benefits of this amount of money being put into service against the pandemic. Just to let you know, and then we'll segue into the real stuff, everybody thinks that because of the hit to insurance, that premiums are going to start rising on many, many, many lines of insurance worldwide, including in the United States, for years to come. This has, and it might sound a little counterintuitive, attracted enormous amounts of money, new money, investment money, mostly hedge fund money, to create insurers, especially new insurers, that aren't saddled with all these unanticipated losses, but can enjoy the increased premiums that are to come. So one odd thing is that a lot of insurance is refinancing itself, even as we speak, but we'll be paying for that refinancing. Let me talk about some different lines of insurance and then get to the two types of insurance that I gave you documents on. And of course, I know many of you are especially interested in business interruption insurance, which is, I suppose, if there's a really hot area of insurance in the pandemic, that's it. and I gave you, we happen to be the home state of one of the most cutting edge decisions on business interruption insurance. And I gave it to you, and it happens to be brought by a restaurateur that many of us know, and restaurants that many of us know. But let me just start with life insurance. The reason I talk about this, of course, is that because of the risk of death, as the pandemic took shape a year ago, all of a sudden life insurers were flooded. I'm not talking about term life insurance. We're just flooded with new applications. Everyone thought, oh my God, I'm going to get this thing and die. And my dependents are going to be left without. And so what's not uncommon is when suddenly it looks like a disaster is upon us, people suddenly get a little religion about life insurance. We see the same thing, by the way, with storm insurance. Lots of people go without, especially on the wind side, until storms are almost named. Then they see them on the Weather Channel and they call us up and they want insurance at the last minute. We have mechanisms, by the way, at which point we don't write insurance when this thing is imminent. For the same reason, by the way, there was a flood of insurance. Insurers' first views were, well, you know, for starters, we're not even sure we can take your applications, because when you apply for life insurance, there's what's known as basic underwriting, which means there's a paramedic or someone that will look at your vitals, give you what looks like sort of a physical light. They'll look at your height, their weight, they'll take your blood pressure, things like that. And yet, lockdown orders actually prevented, at that time, prevented that kind of staffing. So there was this flood of new interest. Partly it couldn't be processed because it couldn't be processed. Partly, of course, insurers were suddenly balking. There were immediate questions that popped up that they began asking, like, do you actually have COVID-19? If you did have COVID-19, they would not accept your application. And of course, you know that if you lie on a life insurance and within the 2-year incontestability period, the bad thing happens. The typical law of misrepresentation will kick in and it can invalidate the payoff. So they began to ask, and if you actually had it, they wouldn't process you. And sometimes they would say, well, come back and talk to us when you don't have it. And so there was this sort of an idea, but insurers nonetheless were certainly writing insurance. In some ways, there was an enormous amount of new business. And frankly, the lion's share of people that get COVID-19 are not going to die. So insuring a whole bunch of new customers who are afraid of death, but actually aren't going to die is a business opportunity for life insurers. They put a few new restrictions right up front, like they didn't want especially older people, or if you were in what was then viewed as a COVID hotspot, they would delay deciding whether they were going to write that kind of insurance. But eventually, life insurance has sort of returned more or less to normal. In fact, so many more people have got into term life insurance vis-a-vis those people that sadly die from COVID, that the general projection is that premiums will stay flat or even actually decrease. There's so much more money, and for most people that get COVID, it does not trigger a life insurance payout. I will mention a couple practical things. Many people get life insurance as a part of their group policy through employment. And so if they are fired from their jobs because of the economic downturn or furloughed, there's a question about whether they keep their their life insurance that they purchased from a group policy. Insurers are actually all over the map, and there's no generally good answer to it. One of the most insured-friendly policies is that by MetLife, which says, you know, if you lose your job or you're furloughed, you may keep your employment-based group life insurance for the next year. You have to keep paying the premiums, of course, but you can keep it. And then hopefully before the year is done, you're back at your job or you're in another job and you might be able to get group life as well. One thing, and the last thing I'll say about life insurance is life insurers are wondering, however, about how to factor in COVID into the future, the thing that isn't known at this point. And you've heard about it, and I don't want to worry anybody about it, but insurers are always worried about things, is we're not sure yet of the millions of people that get COVID and recover. You know, we've all heard stories of risks, of residual risks, long-term health risks that stay with us long after we've recovered from COVID-19. Well, those long-term risks, you know, apart from the risks they might pose to medical insurance pricing, they may, we just don't know, affect mortality rates. So insurers are sort of getting information about it. It is exceedingly common. If you apply for life insurance now, for one of the questions to be, have you had, not do you have, but have you had COVID-19? And then insurance companies actually differ in their underwriting practices. For some insurers, that's it. You know, really risk-averse insurers would say, we're not going to insure you. Others would say, okay, we might insure you, but you're going to have to pay a little bit higher premium. Call it the ambiguity premium, because we don't really know what the increased risk is, but we have reason to think it's something. That's just a good example of when we get this sort of insurance and the worst case happens, how we use insurance to deal with loss of income, which is, of course, for our dependents. It immediately gets to a second type of insurance, which is workers' comp. Workers' comp, of course, can be triggered by death and has sort of death benefits when workers' comp happens. But more importantly, it serves as a stream of income for people that cannot work because, for example, of COVID-19, perhaps, or other occupation-related workplace illnesses or diseases. And there are limits, of course, to how much one can get. One thing to appreciate is that, and most of you know this, workers' comp just doesn't cover, it excludes you getting sick in your employment just like anybody would get sick, the ordinary diseases of life, like the flu. And, you know, if you happen to catch the flu from a co-worker, that's not usually viewed as a workplace illness because you could get it just so generally. So there's two ways in which you can qualify COVID, for example, for workers' comp. First, there usually are lists put out by different jurisdictions in which certain types of work get the presumption that if you get a certain disease like COVID, it is workplace related. So some states have said things like, well, health workers, for example, or dental workers, for example, have a uniquely larger than normal exposure to COVID. And so we're going to make a presumption that if they get COVID, the presumption is they did get it from their workplace. It is just a presumption. And of course, the insurer can probe it, can challenge it, and so on. The more the rest of your life involves embedding yourself in a place where there's COVID, or the area in which you live is an area that, as we can see on the newspaper every day, you know, might be viewed as extremely high risk. It weakens the argument that it came from the workplace. OSHA has issued guidance saying sort of what I just told you. Healthcare workers, dental care workers, airline workers are those that presumptively are at higher risk. But even if you get that presumption, it is still the burden of the claimant to prove that the workplace caused the disease. And so, you know, the burden is still on the claimant to show that it was the workplace, not exposure to COVID elsewhere. And that has proven to be an insurmountable burden regularly. I mean, there have been plenty of workers' comp claims made and paid for COVID-19, but there have been many, many, many claims denied, even from people who are in these high-risk presumptive jobs. insurers, workers' comp insurers have denied them successfully. So there's a burden of proof issue that has to be there. That's the point I just made. So tens of thousands of these claims have been and may continue to be made. And it's worth noting it before we move on. Generally speaking, it's a pretty manageable expense. Mostly people don't die. A workers' comp will cover some of the loss of income that you suffer, and to some extent medical issues, until you recover, which most people do, and then they go back to work. I mentioned the Meatpacker case just as an illustration. Some of you even may have heard of it. One early case is someone contracted COVID-19 from meatpacking, which was and still is a notorious COVID exposure area. Lots of people working in close proximity, and there were hotspots in meatpackers, and it was identified in the press and elsewhere. You might remember just as the disease progressed through our society. One worker actually filed workers' comp, went home, got worse, went into the hospital, and then died. And then brought a claim, among other things, a workers' comp claim, claiming that his COVID and the death from COVID was workplace related. The employer denied the claim. And even though in this case, meatpackers were presumptive industries, denied the claim and said, no, there's a lot of other places you could have gotten this. You haven't carried your burden to show that it's here. Now it's in the courts. But I'd be remiss if I didn't talk about workers' comp. Unemployment insurance does relate to one of the documents that I gave you. And of course, we've all heard of unemployment insurance. And one of the big problems with COVID is that people lose their jobs. And they lose their jobs because the businesses close or downsize. You know, to some extent, it might also be that you don't want to go into work. But the bigger issue is these businesses are not open. Think of restaurants, for example, during much of the lockdown. So here is the nuts and bolts of unemployment insurance. You should just realize that at this point, unemployment insurance is more my other area of expertise. It's more of a regulatory program, an administrative law program, than it is a pure insurance program. The Department of Labor oversees what really is a state government-run program. The basic protection that one gets provides about 26 weeks of benefits, generally speaking, at half your wages, up to a maximum amount. One of the first things that happened with COVID, as this 26-week period, especially after the economy locked down and people found themselves out of work and they were coming up on the 26-week limit, is an extended benefit package was passed. And that was passed in the original CARES Act that you might remember was passed 1 year ago, in March 2020. And it provided full federal funding for extended benefits of unemployment insurance up through the end of that calendar year till December 31st, 2020. And as that deadline was nearing, you may remember that President Trump signed a relatively modest but hardly unimportant extra extension that provided until March, right now, 2020, further extension of pandemic emergency unemployment compensation. And you can see the odd acronym that's there. We are right there at this moment. I believe that no brand new claim for new extended benefits can be filed after March 14th, which is like the end of next week. And all benefits stop in April. That matters, just to finish up the bullet points, because it helps to frame the current Biden stimulus bill. The current Biden stimulus bill that has passed the House and is awaiting action in the Senate would extend this benefits, the extended benefits, up until August. And it would provide an extra $400 a week, which can be a lifeline for people, especially low-wage families, that they would still suffer as the economy still stays relatively depressed. We'll see. If that passes, of course, that would happen. There were some other features of especially the CARES Act and the extension that occurred in December that are worth mentioning. But that's the big frame, big picture view of unemployment insurance. Here is another thing that's relevant. Of course, generally speaking, to get unemployment insurance, you have to be employed. And usually that means you are a traditional full-time worker. So like, what about the gig economy? What about Uber drivers? What about people that, in fact, you might call it working for themselves? Whether they do it in the traditional sense as independent contractors or they're Uber drivers. The short answer was, generally speaking, they were not eligible for unemployment insurance because they weren't employees. The CARES Act created new classes of workers, including self-employed, those were seeking part-time work, and those that had to leave employment for compelling family reasons, like the kids are out of school or to take care of a dependent who is sick or vulnerable. Suddenly they became eligible for these extended benefits, and those are still in place. Those stop to be in place in a week and a half or so from now, unless the Biden bill kicks in which case it might extend benefits for this class of workers besides extending benefits for all workers into the summer. So that's worth keeping an eye on. One inflection point that's probably worth mentioning is as the virus gets under control and as employment starts to gear up again, some employees will not want to go back to work. I mean, this is exactly the dispute that's having with teachers and reopening the schools. But others might not feel comfortable. They think, I actually don't think it's a safe workplace. From an unemployment insurance point of view, the general rule is if you do not return to work, you become ineligible at that point. There is a provision in North Carolina for the relevant agency to actually consider whether you have good cause. And if you can make that good cause showing, then you might still be considered an employee for the purpose of getting these extended unemployment benefits. The showing generally is that you are either over 65 or you have some medical condition that puts you at higher risk. Or sometimes you can make a showing about why you think your employer and the particular place of employment where you work isn't taking the virus seriously. You know, they're letting people in unmasked or whatever. You make a showing like that, and you might still be able to receive unemployment insurance. But that's where unemployment insurance as a program is. One of the last things, of course, I'll mention is this has taken a huge hit to the unemployment trust funds that take place. The unemployment trust funds that that fund all of this. And as those have gotten increasingly stressed, there's a real issue of, as the pandemic wanes, how are we going to build up those trust funds? That's going to be a big financing issue for the health of unemployment compensation going forward. North Carolina has one of the weakest, frankly, most shameful unemployment insurance benefits programs in the country. And yet it too will look at financing squeezes even to maintain its current crummy level of benefits. It is possible that if the Biden bill passes, you may have noticed there was $350 billion that is identified in the bill that's going to go to states and localities. One of the big claims that states and localities will have on that amount of transfer would be to use some of it to help replenish the unemployment insurance trust funds so that as people do go back to work, the program can continue as normal and hopefully maintain the benefit levels at where they are now, or in North Carolina's case, you know, God willing, actually imagine increasing them. But those are down to earth issues that deal with unemployment insurance. let me talk about this because it shifts from employees to employers. And frankly, this is the thing that I am most asked about by the private bar in general when the pandemic started to hit. All businesses, or almost all businesses, have a general property insurance policy that guards against, what happens if there's a fire, just something traditional, and it burns down, and you need to have money to rebuild. Everybody has that. These policies are what's known as all risk policies, which means they cover any risk that could happen to the business unless it is excluded. And then there are, plenty of exclusions. One type of coverage that is usually bought extra is something known as business interruption coverage, which of course, I'm sure most of you are familiar with the basic idea. And the best way to think about it is think of a car dealership. In the event of an extreme snowfall, for example, you might get so much snow that it actually crushes the roof of the dealer's showroom. And that's where the business offices are and other things. And for a period of time, the business has to close. There are two insurance issues when that happens. The first, the easy one, is the property of the business has been damaged. And assuming it's not excluded, it wouldn't be probably with the snowstorm. The money to rebuild the structure is going to be there, and the business will go about the business of rebuilding, getting back on its feet. Business interruption involves the income that is lost as the business recovers. It might have to close for 2 weeks, and it has expenses, including payroll expenses, all the people that are normally on their payroll, and they have other expenses. They have their regular bills that are due. So to guard against that, people buy typically in many regular property insurance, commercial property insurance policies, business interruption coverage, which, just like it sounds, will provide for a certain amount of money for the second scenario that I just described for you at the car dealership. And, I won't go into how much money and how quickly you have to get on your feet and so on. Those are actually very easy to understand and solvable issues. The real question is, what triggers it? What triggers it? The University of Pennsylvania Law School has a COVID coverage litigation tracker, which, this isn't a great slide, and I apologize for how small it is. The beauty of this slide is it tracks the overall number of business interruption claims that have been filed throughout the United States in both federal and state courts. I can tell you that there was an attempt by the plaintiff's bar to actually get this qualified for multi-jurisdictional coverage, in which case these big firms would then come in with representing everybody, which would be very lucrative for those firms. And they would get it certified so that it could be a multi-district adjudication. It failed. They were viewed as too many variables, so that it is left to the various state courts, and to the extent it's in federal courts and individual cases, to deal with business interruption. As of Monday, this is current as of Monday, there are 1,500 business interruption cases that have been filed in the United States in federal and state court. And as you can see, a huge number of them were filed early in the pandemic when the lockdowns happened. And that's when these businesses just were forbidden to open, just straightly locked down. They filed these claims with the hope that it would be one of the only ways they could survive, without firing everybody or even making payments. And you could see them filed. They still continue to be filed, but at a much lower rate. This is the cumulative filings that have taken place. Again, this isn't the amount of marginal new cases that are filed, but you can see the overall amount is right here at about 1,500 cases as of Monday in federal and state court. Almost none of these, as it's been just barely a year since these started to be filed, have gone anywhere near a final decision. On the other hand, there have been lots of motions in the meantime, motions to dismiss, motions for summary judgment. And I can just tell you, actually, let me just go back for a moment before I show you the slide. From an insurer's point of view, remember, this is somebody, a plaintiff, a small business on the one hand, and on the other hand is an insurance company. The general rule of thumb from an insurer, when you're in litigation, is you want to get this case dismissed. Or put another way, you do not want to go to a jury. Given a choice between the small business and a big insurance company, it's not anything most insurers want to happen. So these motions to dismiss or motions for summary judgment on the insurer's side are super important. So if you break down this litigation into those that are in federal court and those that are in state court, as of Monday of this week, this is where these courts are. Now, remember, there's 1,500 cases, and you can see here, what are we dealing with? 160 or something cases. The lion's share of them haven't even progressed to the point where decisions on motion to dismiss or motions for summary judgment have happened. But of those where those decisions have taken place, just notice that the overwhelming result is dismissal, pretrial dismissal. And so, you can just see here, the only time when, again, these are all motions brought by insurers, they are denied is just a small fraction, the blue pie slice here, where that's denied, which means that the case continues. That's federal court. It shouldn't surprise you that cases that are in state court, even at this early stage in the litigation, they are much more forgiving to plaintiffs. Insurers' motions have been denied. Now we're getting into some numbers, almost half the time when those motions come up. So state courts are less likely to grant motions to dismiss. And I mean, there's at least less likely. It's still, very common to see full dismissals or partial dismissals. So these things can survive early motions. So now I can start to get into just the anatomy of these cases, and then I'll leave maybe 10 minutes for some questions. One of the first things I can tell you that is important if you review your client's policy or you're going to sue someone and you get access to the policy is to see whether or not there's an exclusion specifically for viruses, for business interruption caused by viruses. After the earlier SARS epidemics of a few years ago, the insurance industry started to write new exclusions that specifically said, hey, if this thing happens again or actually happens like a pandemic, we don't want to be anywhere near this. If there is a virus exclusion, that's the first thing to look at. Your chance, if you're an insurer and you have a virus exclusion in your policy, your chance of getting a motion to dismiss being granted is very high. This policy is crystal. We don't cover this. And you can see motions to dismiss are granted 106 out of 122 times when there's a virus exclusion. So that's one of the first things that one looks at. Many policies do not have a virus exclusion. And let me actually just go past this to what I asked us to look at. And in 4 minutes, just look at this case. This case is from a Durham court, a Durham state court just in October. And the thing that's interesting about this is it issued a motion for summary judgment to the restaurateur plaintiffs. It didn't just reject a motion for summary judgment going the other way. It granted a motion for summary judgment and ended the case with a victory for, among other things, some of our favorite restaurateurs and restaurants. I don't know about you, but the North State Deli that you might know in the Chapel Hill and Durham area, Perizade, Vin Rouge, which are in Durham, they're like some of my favorite restaurants. They were the winners in this case. The plaintiff's firm that handled this was the Painter law firm, and there was a young attorney named Gagan Gupta that associated himself with Painter in order to bring this case. He and his girlfriend were actually going to be married at Vin Rouge when this pandemic hit. And suddenly their wedding plans, their reception plans fell apart because Vin Rouge couldn't even be open. And he was talking to the owner and said, gosh, I feel so bad for you. We love this restaurant. Are you covered for insurance? And the owner said, well, I'm not entirely sure. Would you take a look at the policy? The rest became history in terms of what happened. Let me just take a moment. I'm going to do something a little odd for a moment. If I don't know whether I am large or not, but if I am, let me just tell you what happened in this case. First of all, the reason that the plaintiffs won is there was no virus exclusion. That became quite important. And in fact, it turned out the restaurateur actually gave evidence that the insurance company said, well, you could get this policy a little cheaper with a virus exclusion. And the restaurateur said, no, we actually remember the SARS case. We actually don't want that. And we're willing to pay a little bit more to get coverage without it. So that helped. The second thing that happened is many business interruption cases as a trigger say that you can get business interruption coverage when there is physical damage to your properties that cause you to close. Remember my example of the car dealership and the showroom collapsing? This is very often the trigger. This policy said that the business interruption coverage would be triggered if there was physical damage or physical loss. To be honest, if you know anything about insurance cases, that's all she wrote. The general rule in insurance is something in interpreting policies is to the extent there's an ambiguity, it favors the insured. After all, it is the insurer that writes these contracts of adhesion. And if it's their language and you construe ambiguities against the insurer. So the fact, first of all, that there was no virus exclusion and that not only physical damage to the building, but physical loss was covered. An important word was the word or to the court, and the distinction between loss and damage. They don't mean the same thing. And the restaurateurs were able to say, well, in some ways, our business wasn't damaged. Some businesses, for example, say, well, it was. These fomites, were on our business. That's a hard course when you have to prove damage. But loss, he said, the governor actually shut down my business. We were forbidden to open. And physical loss means we weren't able physically to access the premises. And this was due to the government's order, which of course was created by the pandemic. And given the ambiguity doctrine, loss means something different than damage, which was very clear. There was no virus exclusion. Summary judgment for the, in this case, for the business. To this date, one of the most pro-plaintiff results that has happened in the country out of these 1,500 happened, 4 months ago, right here in the Triangle, which is remarkable. And a testimony, by the way, to this young lawyer who just did a great job. I read his briefs on this. It was just brilliant bit of lawyering. The insurer has appealed. So, we'll wait to see as it works its way up the chain. Well, I'm getting close to the end of my time. And although I could do 1 or 2 more things, why don't I ask if there are questions? I sort of see things happening on the chat, but I haven't really been paying attention. By the way, this thing that I'm writing on is called a Lightboard. I actually built it in my house, took out a room in the summer, built it. It took me a few weeks, built this thing from a kit. I still got it. And I wanted to teach in a way, don't you just get sick of PowerPoints after a while? So when I teach my students, I teach from this little Lightboard studio. You can see this dark thing behind me. And I can write, and teach the sort of way I normally would in a real class, without being as stilted as we sometimes are with PowerPoints. So aren't we happy that this is?
It is fantastic. I'm totally enthralled with this technology. So we have a couple questions here that I can read in. Yeah, so we have about 5 minutes, would be great. This is totally fascinating. I'm really interested in that reinsurance piece. I knew a little bit about it, but it's just really interesting. So one question for you is this. If you were advising a fledgling nonprofit about what types of insurance they should be thinking about, what would you tell them? If this insurance is something totally foreign to them, what should they be thinking about? What types of insurance should they be considering?
Oh, well, of course, you're going to want general liability insurance and general property insurance. I mean, to the extent that there is property. It depends then on the nonprofit. Some nonprofits, I'm thinking of my own son who has a startup, who had a startup that was sort of just a software sort of thing, but then it eventually had actual physical location. You'll want property insurance and you want liability coverage, just your regular commercial general liability, the CGL policy, and a basic property insurance policy. Businesses also can often opt into employment practices liability insurance, which often is sold separately from general liability. And it has to do with just things that could make you liable as an employer. And, I understand you talked about it being small. So nonetheless, there are certain types of things that can happen, certainly cases that can be brought against you. And so just, and whether that's worth it as a risk, that's hard for me to tell in terms of the extra money you would need. But needless to say, the smaller you are, the less expensive it's going to be. You'll pay attention to the limits that you can buy the insurance for. That can also affect this, as well as the deductible amounts, in which all affect the pricing. So it would be a mix of things, but I would definitely start with basic CGL liability policy and property insurance. It's just something almost all small businesses, profit or nonprofit, need to have.
Okay. The next question, should a nonprofit be taking practical steps in advance of an insurance claim to situate themselves best if they have that flexibility, if they have time? If they're anticipating a claim, what would be some steps that they could take?
So some of it means what you mean by anticipating a
Right.
claim. If the bad thing has happened and you think now that they're going to sue you for it, no, it's too late. So, if on the other hand, you say to yourself, hey, maybe I shouldn't be treating my employees this way, or maybe I really should make people wear masks before somebody sues us. Yes, of course. Insurance is one way to deal with risk, but there are innumerable other ways we reduce risk. I mean, we reduce risk when we drive, not just by having auto liability insurance, but by not driving over the speed limit, by not driving drunk. Don't do those things as a business. As a general practice, that's always a good idea. And by the way, if you build up a record of not having claims filed against you, and certainly not having successful claims filed against you, over time, insurance becomes more affordable to you, just like it does with auto insurance, and vice versa.
Okay. All right. And then we have one final question. It's just more of a general question. So, one of the earlier presenters talked about this director and officer insurance. And I'm just wondering if you could tell us a little more about that. It got mentioned briefly, but just what that is.
Sure. So D&O insurance has to do with people like me, where I am, in fact, on the board of directors of a company. In this case, it happens to be a nonprofit, but it doesn't matter. It's in business. And involves, millions of dollars. It is possible that the entity does something for which lawsuits are brought directly against the directors and the officers, qua directors and officers, as a separate class of defendants than the actual juridical entity, the company. And, it's done for a variety of reasons, but certainly when I sit on a board of directors, I know that decisions I make as a board member could, in fact, open me to a lawsuit in that capacity. And so I am relieved to know that the nonprofit for which I work has D&O coverage for me. And to be honest, they were very clear before I was put on this board. It's one of the first things I asked. And the reason I ask is that our counterpart board in Texas, for example, that deals with wild weather in Texas, their members of their board have been sued over 500 times. And among other things, when you have D&O insurance, it provides lawsuit coverage, so the lawyer's fees are covered. And then two, indemnity in the event you did do something in your capacity as a director that's actionable, it would indemnify us up to that point. So as a practical matter, certainly if you're going to have a board, that's something almost any board member, even in a nonprofit, cares about, because once you're affiliated with a nonprofit that way, you take the bitter with the sweet. One of the best things I've ever done in my life is serving on the board of this nonprofit. But I'm mindful of the grown-up risks.